Hello, everybody. I'm recording this lecture on January 3rd of 2022. This is Module 7, which deals with GILTI, FEDII, and BEAT. And let's start this lecture, Module 7, with GILTI, which stands for Global Intangible Low Taxed Income. And what I'm going to do now is walk through the Steptoe and Johnson, it's a US law firm, produced these PowerPoints in January of 2018, right after the Tax Cuts and Jobs Act was enacted, which enacted GILTI, FEDII, and BEAT. They do not include any regulations or IRS guide, other IRS guidance issued, after the enactment of the statute. But I think they're still, very helpful. So let's walk through these PowerPoints dealing with GILTI, Global Intangible Low Taxed Income, and then I'll add some additional materials. So let's go down the page. Hopefully everybody can see this. So the act, meaning the Tax Cuts and Jobs Act, includes a new provision intended to discourage base shifting to low tax jurisdictions. That, by the way, is Section 951, capital A. There's a deduction for GILTI as well as for FEDII, which is contained in 250, but the bulk of the GILTI materials is in Section 951, capital A, enacted as part of the Tax Cuts and Jobs Act at the end of 2017. Let's look at the second bullet. The provision requires a current income inclusion similar to that for Subpart F income. For Global Intangible Low Taxed Income, or GILTI, GILTI is an acronym for Global Intangible Low Taxed Income. The provision is effective for taxable years beginning after December 31st, 2017. GILTI rules generally apply to U.S. shareholders owning 10% or more of the CFCs. The rules apply to all U.S. shareholders, i.e. corporations, individuals, and pass-through entities. So, corporations and individuals can both be hit with the GILTI inclusion. GILTI is taxpayer unfriendly. Unlike FEDII, which provides a benefit, GILTI is an inclusion, additional taxable income. The new GILTI rules essentially impose a minimum level of U.S. tax on the foreign profits of U.S. multinationals. By the way, again, I'm recording this on January 3rd, 2022. Congress did not, in 2021, pass the Build Back Better Act, which would have made substantial changes to GILTI and FEDII. And BEAT, for that matter. I don't know. I'm not sure what's going to take place in 2022. To the extent that there is new material, then I'll record an updated lecture covering that. Let's go to the next slide. So GILTI equals net CFC tested income minus 10% of QBI. QBI stands for Qualified Business Asset Investment. And it said minus interest expense. But you see there are two minuses. So applicable interest expense is really an addition of, therefore, increasing GILTI inclusion. And we'll talk about the exclusions and deductions in a while. Let's go to the next slide. So net CFC tested income is the aggregate excess of CFC tested income over CFC tested loss. Tested income is computed by taking the gross income of a CFC, excluding certain categories of income, and subtracting deductions, including taxes. With that, they mean foreign taxes. The exclusions are: one, income effectively connected with U.S. trade or business, known as ECI; 2, income taken into account to determine subpart F income. 3, income excluded from subpart F by the high tax kickout. 4, dividends received from related persons. And 5, foreign oil and gas extraction income. The last bullet says, note that a GILTI computation requires the computation of exclusions first. Accordingly, before determining GILTI, one must first compute effectively connected income, ECI, and subpart F income. I talked briefly about subpart F income in the introductory module. Remember, on certain types of bad income, there's an immediate inclusion in the income of a U.S. shareholder. A U.S. shareholder, by the way, is defined as a U.S. person, including a U.S. corporation, U.S. individual, owning 10% or more of the voting power or value of a controlled foreign corporation. Let's go to the next slide. Steptoe and Johnson continues to again go through the equation. The concept of net deemed tangible income return essentially requires a computation of a routine deemed return on tangible assets and is calculated as 10% of the shareholders' pro rata share of the qualified business asset investment, known by the acronym QBI, QBAI, of each CFC with respect to which is a U.S. shareholder over interest expense not already attributable to CFC tested income. I just want to add something here that I'll try to reinforce later. In terms of this reduction of 10% of QBI, that only applies to a CFC with tested income. So it's a sort of a taxpayer unfavorable rule in that if you have specified tangible property in a tested loss controlled foreign corporation, that has no effect on the amount of GILTI inclusion. So that hurts taxpayers. You can't use those tangible assets if at the end of the day, the CFC generated losses as opposed to income. The next bullet says QBI is determined as the average of adjusted U.S. tax base determined at the end of each quarter of a tax year in specified tangible property that is used in the CFC's trade or business and is subject to U.S. tax depreciation. And the depreciation is computed more slowly for this purpose. The last bullet on this slide says specified tangible property means tangible property used in the production of tested income. Note that the statute appears to suggest a CFC that does not have any positive tested income, e.g. because it has a tested loss, does not have any specified tangible property, and therefore does not contribute toward QBI, and that's made clear by the regulations. So again, if you've got specified tangible property located in a tested loss CFC, that will not reduce QBI inclusion. Just too bad. The next slide, which I think is slide 38, 37, I'm sure. Note the definition of deemed intangible return means that the operations of many different types of CFCs could result in GILTI inclusion for U.S. taxpayers. The provision is not limited to IP-heavy companies. So even though it's called global intangible low taxed income, you could have a GILTI inclusion and have no intangibles. So it's not limited to IP-heavy companies. GILTI could apply to a service-focused company with low tangible assets. GILTI could also apply to a manufacturing company with depreciated assets and thus low QBI. GILTI could apply to any company with high returns compared to tangible assets. I think that's the key. Let's go to the next slide. Available foreign tax credits may be used to offset any tax owed as a result of a GILTI inclusion, but such foreign tax credits are reduced to 80% of the foreign taxes attributable to the tested income of the CFCs. When foreign tax credits are claimed, the GILTI inclusion is increased by 100% of the foreign tax as a result of the gross up under Section 78. So under current law, and this would have been changed had the Build Back Better Act been enacted, you only can use 80% of available foreign tax credits, but all of the foreign taxes are deemed to be an additional inclusion in the income of the taxpayer pursuant to Section 78. Foreign tax attributable to GILTI are determined by multiplying the total foreign taxes of CFCs by the proportion of GILTI compared to tested income. Foreign tax attributed to GILTI are treated as a basket category under 904 that is separate from the general and passive category income baskets for foreign taxes. There are no carry forwards or carrybacks of unused foreign tax credits attributable to GILTI. So as I'm recording this lecture on January 3rd, 2022, the current law is that you only get 80% of credits. That would have been 95% had the House version of the Build Back Better Act been enacted. And you can't carry excess credits back or forward. So the rules about carrying it back 1 year back, 10 years forward do not apply to foreign tax credits in the GILTI basket. The result is a number of taxpayers can't utilize the credits because of the 904 limitation in the GILTI basket. That is when they allocate and apportion expenses against gross GILTI foreign source income, they're unable to use credits, and those excess credits can't be carried back or forward. Again, this would have been changed favorably to taxpayers had the Tax Cuts and Jobs, the Build Back Better Act been enacted. We'll see what transpires between now and when this course commences. So I think I've gone through that whole slide. Let's go to the next one. Let me take a drink of water. So U.S. U.S. corporations may claim a deduction of 50% of any GILTI inclusion in taxable years beginning before December 31st, 2025. This would have been reduced under the Build Back Better Act if the House version had been enacted. For taxable years beginning after December 31st, 2025, deduction is reduced to 37.5%. As a result, the effective tax rate for U.S. corporations on GILTI is 10.5%, 50% of 21% prior to 2026, and 13.125% in 2026 and years after. The foreign tax credit rule and deductions mean that the minimum foreign tax rate to compute a U.S. tax on the GILTI inclusion for U.S. corporation shareholders is 13.125% prior to 2026. In brackets, they write 10.5% is 80% of 13.125% and 16.40625% in 2026 and years after. 13.125% is 80% of 16.40625%. Third bullet, note that GILTI computations and available foreign tax credits are determined at the U.S. shareholder level based on aggregate ownership of CFCs. As a result, it is possible to cross-credit high foreign taxes in one jurisdiction to mitigate GILTI tax. This would have been changed had the Build Back Better Act been enacted I think this provision would have been terrible, very, very complex. You would be computing GILTI country by country, so I think that would have been a terrible outcome. We'll see what transpires. And the last bullet says it's unclear whether these computation aggregated in the case of multiple U.S. shareholders that are members in the same U.S. consolidated group. And it's clear now that they are. I wanted to add something. While the GILTI deduction and foreign tax credits are available to corporations, an individual can elect under 962 to be taxed as domestic corporation. And if it makes that election, individual makes that election, it will get both the GILTI deduction, currently 50%, as well as the GILTI foreign tax credit. The credit, the deduction was made clear under regulations issued after these slides were produced. So individuals need to, strongly consider, making that election to be treated as domestic corporations. Let's go to that next slide. USC corporations are treated more favorably than other U.S. taxpayers in the GILTI tax rules. Again, as I told you, an individual can elect to be treated as domestic corporation. U.S. corporate rate is lower, 21%, and the rate for individuals, 37%. That's true. That continues to be the case. The third bullet says the deduction of a portion of the GILTI inclusion only applies to USC corporations. Again, the slide assumes no 962 election to be treated by an individual to be treated as a corporation, further increasing the disparity of the consequences of GILTI between a USC corporation shareholder and a US individual shareholders. Let me just add to that. So let's suppose the individual doesn't make the 962 election. Let's see what happens. First of all, if he's in the highest bracket, he or she is taxed at a 37% rate. That compares to a C corporation, which will pay tax not at the 21% rate, but really at a 10.5% rate because of the 50% current deduction for GILTI by C corporations. Furthermore, a C corporation can potentially avail itself of foreign tax credit relief. If an individual will not get a foreign tax credit relief under 960, if it doesn't make an election to be treated as domestic corporation under 962. I think I read the fourth bullet already. If I haven't, please read it on your own. The next bullet says, the general matter, a U.S. partnership can be a U.S. shareholder, but the rules are applied on a look-through basis to the paying partners in the partnership. U.S. corporations that are partners in a partnership that is a U.S. shareholder may be eligible to claim foreign tax credits in the GILTI deduction. And the last bullet on this page is, as a result, GILTI does not operate as a minimum residual U.S. tax on low tax foreign income with respect to individuals. For individuals, GILTI is a full additional U.S. tax and better described an expansion of subpart F. So if you don't make that 962 election, GILTI can be fairly horrendous for an individual because you can be taxed at that maximum rate of 37% with no credits. And I just want to go through this last slide. Again, this was prepared before regulations were issued. I'm sorry. So section 962, looking at the first bullet, allows a U.S. individual to elect to be taxed as a corporation for purpose of subpart F inclusion. The Act, the Tax Cuts and Jobs Act, provides that section 962 applies to GILTI inclusions as well. Consequence of section 962 election, tax imposed is generally an amount equal to tax which would be imposed under section 11 if such amounts were received by a domestic corporation. Electing shareholders entitled to a deemed pay credit for foreign income taxes as if the shareholder were a domestic corporation subject to limitations. Section 962 also provides rules for treatment of an actual distribution of earnings and profits previously taxed in accordance with the election of benefits. And this last bullet is out of date. It says unclear whether a section 962 would allow an individual to claim the benefit of GILTI deduction available to corporations. The answer is it's clear now. An individual can get the GILTI deduction by virtue of a 962 election. I'm going to stop sharing. So again, I hope you found Steptoe and Johnson beginning on slide 33 beneficial in terms of giving you, a foundation in terms of your knowledge of GILTI. Again, I'm not going to be covering everything that GILTI touches upon. I'm just trying to give you a basic understanding of the provisions. And I think the Steptoe and Johnson slides were very good in that regard. And I hope you agree. Again, you have any questions when we go through the material, just shoot me an email. And, a lot of people have questions. Maybe we can try to have a synchronous Zoom session to try to answer, questions that many of you have. So as I said, section 951 cap A, the so-called GILTI provision, GILTI again being an acronym for Global Intangible Low Taxed Income, is covered in your book in 69 capital A. Professor Loken rewrote that in the last year or so. I think they did a good job. Like sections 965 and 59 cap A, the BEAT provision, and unlike section 245A and FEDII, GILTI is a taxpayer unfavorable provision. It was meant to stem base erosion resulting from the enactment of section 245 cap A. By base erosion, I mean shifting taxable income from the U.S. companies outside the U.S. Loken discusses the GILTI provision, as I said, in 69A. Let's read 69 cap A, point 1, second paragraph. I'm going to touch on some of the material, obviously, in the Loken book. We don't have time to go through all the material. I would suggest that you read all of 69 cap A. But anyway, in 69 cap A, point 1, second paragraph, Professor Loken writes, Congress also enacted in 2017 a participation exemption. He's referring to 245 cap A in the form of a deduction allowed to domestic corporations for 100% of any dividends received from a foreign corporation in which it held at least 10% of the stock, referring to section 245 cap A. Participation exemption is allowed on the assumption that such dividends come from earnings already taxed by one or more foreign countries. And Congress decided that it needed a backstop to ensure the deduction did not facilitate escape from all taxation worldwide. The need for a backstop, see my lips, the head going on here now, I guess. I'm sorry. The participation exemption, I'm sorry. The participation exemption is allowed on the assumption that such dividends come from earnings already taxed by one or more foreign countries, and Congress decided that it needed a backstop to ensure deduction did not facilitate escape from all taxation worldwide. The need for a backstop was demonstrated by evidence that many U.S. companies, particularly in technology industries, had accumulated hundreds of billions of dollars in offshore subsidiaries that had borne little tax. At the same time, Congress did not want the backstop to negate a principal purpose of the participation exemption to enhance the competitiveness of U.S.-based multinational enterprises. I'm going to show you another slide. Let me do that now. It's a GILTI flow chart I think is helpful. Let me try to find it. Hope you can see that. Okay, so let's look at this GILTI flow chart. So it starts with aggregate pro rata share of tested income of all CFCs minus aggregate pro rata share of tested loss of CFC. So the inclusion is really a net number. Tested income tested income CFCs less losses from tested loss CFCs equals the U.S. shareholders' net CFC tested income minus net deemed tangible income return. Yeah, that's at 10% of QBI equals the GILTI amount. The GILTI amount plus the Section 78 gross up equals the U.S. shareholder inclusion minus a 50% deduction. We're talking about corporations. That gives you the U.S. shareholder inclusion net deduction times the 21% corporate tax rate gives you the tentative GILTI tax. So effectively with a 50% deduction, domestic corporations are not paying a 21% rate. They're effectively paying a 10.5% rate. Anyway, that gives you the tentative GILTI tax. You subtract from that deemed paid foreign tax credits, and that equals the U.S. tax liability to the GILTI shareholder, U.S. shareholder. I'm going to stop sharing. Hopefully this will be on your on the class's website. You can look at your leisure. Let me stop sharing. Okay, let's turn. Let's go back to 69 Cap A, point 1, first paragraph. Let me stop for a little water. Which provides that Congress in 2017 enacted a pair of provisions that require a U.S. shareholder of one or more CFCs to include in gross income its share of any global intangible low taxed income GILTI of the CFC or CFCs, and to allow a domestic corporation deduction equal to 50% of this inclusion. This is provided for, the latter is provided for by Section 250. Professor Loken goes on to write, in essence, a domestic corporation is taxed on one half of its GILTI. The GILTI inclusion is in addition to the inclusions required for Subpart F income and earnings invested in U.S. property. That's Section 956, investments in U.S. property. There is also, as noted, potential foreign tax credit relief for domestic corporate U.S. shareholders to the GILTI inclusion. And as I mentioned to you, individuals can make an election in 962 to get both a foreign tax credit relief and a GILTI deduction, assuming they elect to be treated as domestic corporations, be taxed as domestic corporations. One writer noted that to Subpart F income and the Section 956 inclusion, the Tax Cuts and Jobs Act adds GILTI, another tranche to the CFC earnings that U.S. shareholders must report without actually receiving them. So it's not like a dividend where you actually receive money. This is a deemed inclusion. New Section 951A, 6 next door to 951, which is the Subpart F provisions, because of their many similarities. As Professor Loken notes, I believe in 69A.1, fifth paragraph, the GILTI rules differ in several respects, however, from the Subpart F rules. First, while Subpart F income is computed by identifying particular items to be included in Subpart F income, GILTI is determined by a process of exclusion. All CFC income is deemed to be tangible income, except the portion deemed to be from the discussion below. The differences between GILTI and Subpart F inclusion is dealt with by Jack Cummings in an article in Tax Notes magazine of April 9th, 2018, titled "GILTI Puts Territoriality in Doubt." He points out that GILTI differs from Section 951, which is the subpart F provisions, in a number of ways, including the taxed income is not bad, like passive or foreign-based company income that you have as part of subpart F. It will mostly be active business income. GILTI will be mostly active business income with a higher low tax. Two, new section 950 will have the inclusion, but this benefit is limited to U.S. shareholders that domestic corporations. And again, as I told you, under 962, that benefit is available to individuals electing to be taxed as a domestic corporation. Three, use a rough justice approach as contrast with the precise calculation, precise categories of subpart F in section 956 income. Four, it aggregates and nets positive GILTI CFCs and negative GILTI CFCs owned by U.S. shareholders when it hurts, but not when it helps. I think what Professor, what Mr. Cummings is referring to, he should be a professor. He's not. He's of counsel to a major law firm, but he's certainly a very academic individual. He's written a plethora of articles on anything, on all sorts of aspects of federal taxation. What he means about hurting but not helping, I think what Mr. Cummings is referring to is the fact that that subtraction of 10% of QBI that reduces GILTI inclusion does not count specified tangible assets, depreciable assets located in CFCs with tested losses. So that's what I think he's referring to. And five, it substantially limits the use of indirect credits for foreign taxes attributable to GILTI. As I mentioned before, and this is important, in the current law, you can only use 80% of the credits. You can't carry them back. You can't carry them forward. So it is a problem for many U.S. corporations trying to utilize credits. Many of them find themselves in limitation under 904. As I said, GILTI is its own separate foreign tax credit basket. Just one point. Although the provision requiring the GILTI inclusion is found within the 951 area, the subpart F income area, it is not considered subpart F income. However, in many ways, the treatment is very similar. Let me mention a couple of ways in which GILTI and subpart F are treated the same way. Section 959, which provides that amounts included in a U.S. shareholder's gross income as subpart F income shall not again be included in gross income when distributed as dividends or invested by the CFC in U.S. property. That also, 959 also applies to GILTI. So you're not going to be taxed twice, on GILTI and or subpart F inclusions. So if earnings were, say, included in subpart F income, they're not going to be taxed again under GILTI, and vice versa. And or if you had a GILTI inclusion in year one of certain earnings, those earnings again would not be taxed twice. The second similarity is section 961. Under that provision, the adjusted basis of U.S. shareholder stock is increased by amounts included subpart F and is decreased when the shareholder receives dividends excluded from gross income under section 959. And it works the same way in the world of GILTI. The third similarity is section 962, which allows an individual U.S. shareholder of a CFC to compute tax on subpart F inclusion as though he or she were a domestic corporation. As I said, you can do the same thing now with respect to GILTI, make that 962 election. Another similarity is treatment under section 1248, little d in parenthetical, 1 in parenthetical, which excludes subpart F income from a CFC's earnings and profits in determining dividend treatment of gain on a sale of a CFC stock. You may recall from a prior module, we discussed the fact that under 1248 J and 245 Cap A, with certain limitations, the amount of the 1248 inclusion attributable to E and P can be excluded from taxation, but that only applies to taxpayers who are domestic corporation shareholders owning, 10%, owning the stock in the CFC. You have to own that 10%. If you're an individual, you wouldn't be able to avail yourself of 1248J and 245 Cap A. So this 1248 little d in parenthetical, 1 in parenthetical, it can be very important. I think I mentioned in a prior lecture some regulations which can have the effect of forcing taxpayers, who are getting the benefit of 1248J and 245A to make an election close in the year, in effect picking up the amounts that would be either subpart F or GILTI had the year actually closed on the date of the sale of the CFC. But let's move on. Let's turn to the fourth paragraph in the Loken text under 69 A.1. After the quote from the House Ways and Means Committee, your text reads, a U.S. shareholder's global intangible low taxed income for a taxable year is a taxpayer's net CFC tested income for the year, less the shareholder's net deemed tangible income return for the year. And that's 951 Cap A, little b in parenthetical, 1 in parenthetical. Professor Loken goes on to write, net CFC tested income is generally the CFC's ratable share of the CFC net income or loss of all CFCs of which the taxpayer is a U.S. shareholder, exclusive amounts subject to U.S. tax under rules, for example, subpart F income and net deemed tangible income return is generally 10% of the shareholder's pro rata share of tangible depreciable assets of all CFCs. Very generally, global intangible low taxed income is determined by excluding a deemed return on tangible assets from global CFC income. And we talked about that, again, when we went through the Steptoe and Johnson slides. Let's turn to 69 Cap A .2, talking about tested income and loss. Let's look at the first paragraph. Let me stop for some water. I'm just trying to go through the material I think is the most important. Again, I'd urge you, to develop increased expertise in this area is to read chapter 69 Cap A in its entirety, dealing with GILTI. So I think I'm in 69 Cap A .2, first paragraph. A U.S. shareholder's GILTI inclusion is the shareholder's net CFC tested income, less the shareholder's net deemed intangible return. Net CFC tested income is the sum of shareholders' pro rata share of tested income of all CFCs, of which the shareholder is a U.S. shareholder, less the sum of the pro rata shares of tested losses of all CFCs. Before I go on, I have prepared PowerPoints for all topics, but including GILTI, FEDII, and BEAT. So you take a look at the PowerPoints too. Hopefully they'll reinforce, what we cover in the lecture and what you read in the book. I don't cover everything in the PowerPoints, but I tried to put down what I believe are the most important highlights. So let's look at 69, Cap A, point 2, second paragraph. A CFC's tested income or loss is its gross income exclusive of several items listed below, less the CFC's deductions, including taxes properly applicable to such gross income. The excluded items are: 1, gross income included in determining subpart F income; 2, dividends from related persons; 3, gross income from U.S. sources that is effectively connected with the conduct of a U.S. trade or business in the United States and not exempt from tax or taxed at a lower rate under a treaty. I'll come back to that. 4, items excluded from foreign-based company income or insurance income on the high tax exclusion of 954B4. That's important. There are regulations that dealt with this, but I'm not really going to cover it. And 5, foreign oil and gas extraction income. The regulations refer to the amount of gross income remaining after these exclusions as gross tested income. A shareholder's net CFC tested income for a taxable year is the sum of the shareholder's pro rata share of tested income and losses of all CFCs in which the shareholder is a U.S. shareholder. I think I may cover this later, but let me point something out to you. Only a United States shareholder has a GILTI inclusion, and we look to the United States shareholder owning the shares in the tested income CFC or CFCs as of the end of the CFC year. So if the CFC year is December 31st and the U.S. shareholder sold all of his, her, or its interest in the CFC on December 29th, there would be no GILTI inclusion. There would be no subpart F inclusion and no GILTI inclusion. Let's turn to 69 Cap A 3.1, dealing with deemed tangible return. Let's look at the first paragraph. A U.S. shareholder's GILTI is net CFC tested income less the shareholder's net deemed tangible income return for the year. Net deemed income return is generally 10% of the aggregate of the shareholder's pro rata share of the qualified business asset investment of all CFCs of which the taxpayer is a U.S. shareholder. A U.S. shareholder's pro rata share of CFC's qualified business asset investment is the same percentage of this investment as a shareholder's percentage share of subpart F income. This pro rata share is taken into account for the shareholder's taxable year during or with which the CFC taxable year ends. It's the point I just mentioned a minute ago. A U.S. shareholder's net deemed tangible income return is, however, reduced by any interest expense of a CFC that is taken into account in determining the shareholder's net CFC tested income for the year, to the extent that the interest income attributable to the expense is not included in net tested income. Excuse me, I'm sorry. Sorry. Wait 1 minute. Okay. I just want to be clear about, this related interest. It says less this related interest expense. It's really, if you look at the fraction, the equation, it's really 2 negatives. So, this applicable interest expense is really an increase in GILTI inclusion, not a reduction. That's the big picture I wanted you to be aware of. So I think the key is GILTI inclusion is reduced by this net deemed tangible income return. So GILTI can be reduced or eliminated if there is large basis in tangible depreciable assets, of the CFC, the tested income CFC. However, this benefit is reduced or eliminated by CFC interest expense that is taken into account in determining the shareholder's net CFC tested income. Let's take a look at 69A 3.2, first paragraph. A CFC's qualified business asset investment for a CFC taxable year is the average of the aggregate adjusted basis as of the close of each quarter of tangible property used in the production of tested income that is used in the CFC's trade or business, and is of a type for which a depreciation deduction is allowed under Section 167. Property satisfying these criteria is called specified tangible property, and items adjusted basis is determined for this purpose using the alternative depreciation systems of Section 168G, which generally give you a higher basis, and by allocating depreciation on property ratably to each day during the period of the taxable year to which such depreciation relates. In 69 Cap A 3.2.2, Loken addresses a concept known as dual use property. I just want to touch upon the first sentence, and I suggest you read the rest on your own. Property used in the production of both tested income and other income is specified tangible property in the same proportion as gross income included in tested income produced with respect to such property bears the total gross income produced with respect to such property. The point here is that tangible property may have more than one use, and to the extent it has more than one use, only a proportion of the assets will be treated as QBI in terms of that 10% of QBI reduction. So suppose some of the assets are used for for an excluded purpose and some not excluded. So only a portion of the assets would give rise to this 10% QBI reduction of GILTI inclusion. So, I would urge you to read 69A.3.2.2 in its entirety. Let's go back to 69A.1. Let's look at the last 5 paragraphs. I'm going to read it all, but let's go through some of it. So again, I'm in 69 Cap A, point 1, last 5 paragraphs. A U.S. shareholder must include a GILTI amount with respect to a CFC if the person owns stock of the CFC directly or indirectly on the last day of a CFC taxable year. That's the point I made to you earlier. So that's really important. The inclusion is required for each CFC inclusion year, which is a taxable year of the foreign corporation, during any portion of which the corporation is CFC. A U.S. shareholder must include a GILTI amount for each U.S. shareholder inclusion year, which is a taxable year of a shareholder during which or with which a CFC inclusion year ends. Let's start the next paragraph, and maybe read the rest of it on your own. A U.S. shareholder's GILTI inclusion amount for a shareholder inclusion year is the shareholder's net CFC tested income less the shareholder's net deemed tangible income returns. Why don't you read the rest of it on your own? We covered that before. Certainly went through the Steptoe and Johnson slides. Let's go to the next paragraph. Pursuant to the policy to reach only intangible income, a U.S. shareholder's GILTI inclusion amount is reduced by any net deemed tangible income returned. Why don't you read the rest of that paragraph on your own? Let's jump to the next paragraph. A U.S. shareholder takes its pro rata share of CFC's tested income or loss and deemed tangible income return for a particular taxable year into account for its shareholders' taxable year with or within which the CFC taxable year ends. Read the rest of the paragraph on your own. Let's go to the last paragraph. A U.S. shareholder of a CFC must include Form 8992, U.S. shareholder calculation of global intangible low taxed income, GILTI, with its U.S. income tax return, absent a showing of reasonable cause. A U.S. shareholder failing to complete and include this form is liable for a penalty. I'm going to skip 69 cap 8.4, tested interest expense and tested interest income. But I'd suggest you read that on your own. Just to make sure everybody's with me on the big picture, I think it's important to step back that GILTI operates on aggregation basis. The calculations are done at the level of the U.S. shareholder, which is also the way 965 operates, BEAT operates, and FEDII operate. And we'll deal with BEAT and FEDII in a subsequent lecture. I'm just trying to see what I want to focus on. Let me do an example that I'm not sure is in the latest edition of the Loken treatise, but it was at least in a prior edition. But the example makes a lot of sense, about the GILTI inclusion. Assume US Co., a Delaware corporation, sells all of its stock in CFC1, which uses the calendar year as its taxable year, on November 1st, 2018, and purchase all of the stock of CFC2, which also accounts by the calendar year, on December 15th, 2018. If CFC1 continues to be a CFC after the stock is sold, because the buyer is a US person, none of its tested income is included in the US company's GILTI for its taxable year. That includes December 31st, 2018. The reason for that is because the US shareholder doesn't own the shares directly or indirectly in CFC1 at the end of the CFC year. The example goes on to state, in contrast, all of CFC2 CFC tested income for its 2018 year is included in US Co's GILTI, including portions of this income there's attributable to the portion of the year before US Co's purchase of the stock. For example, if CFC2 had been a CFC for all of 2018, because US Co. purchased the stock from a US person, CFC's tested income for the entire calendar year is included in computing US Co's net CFC tested income taxable year that includes December 31st, 2018. Okay. By the way, 66.9 of your book deals with the deductions for GILTI for C corporations or C corporations. They're individuals that elect to be taxed as a C corporation. It also, 66.9 of the text also deals with the FEDII deduction. Just looking to see anything else that I want to cover. I think I'm going to stop here. Again, I would, if you have any questions, feel free to email me. I will do an updated tape if GILTI is changed by virtue of legislation enacted between now and when your course begins, or and that's it. I will deal with FIDI and BEAT in a subsequent lecture. So have a great day, everybody, and take care. Bye.